Good morning, I'm Guy Johnson. I'm alongside Tom Mackenzie today. We're a little over an hour away from the opening trade. So what do you need to know this Wednesday morning? UBS over-delivering. Q2 net income double what was expected. Wealth inflows staying strong. In the investment bank's bottom line was better than estimates. We're going to hear from the CEO, Sergio Ermotti, in just a moment. The Japanese Prime Minister, Fumio Kishida, announcing that he will not run for a second term. Traders already speculating that his successor could make it easier for the BOJ to raise rates at a quicker pace. And a shock from down under. The Reserve Bank of New Zealand cuts rates by 25 basis points and suggests that a 50 basis point move was discussed, Tom.
And we check in on the markets, of course, with the New Zealand Central Bank discussion and decision in focus. That surprise cut coming through, and you can see it is weighing on the Kiwi right now, down 1% versus the US dollar. European futures set for a positive day. It seems, at least, pointing high by 0.4% strength coming through, of course, stateside in the US, with the S&P notching the four straight days of gains, the best rally in terms of 4 days since the start of the year. 31 futures pointing the gains of 27 points. The US 10-year currently at 384 after the rally of yesterday on softer PPI. The countdown to the opening trade starts right now.
Wednesday the 14th. Good morning. Central banks are still the story today. You've seen a big shock coming out of New Zealand. You've got this speculation coming out of Japan. Will a new leader ultimately allow the BOJ to pick up the pace when it comes to hiking rates? You've clearly got the Fed on deck as well today. It is CPI day in the USA, but it's also CPI day here in the UK as well. We'll get data out of the United Kingdom very shortly. Around all of this, of course, we have the earnings story that continues. UBS is the big story of the morning, but we've got plenty of other CEOs that we're going to be talking to throughout the morning to get a handle on what is happening with this global economy. But Tom, UBS over-delivering.
Yeah, look, the analyst notes had pointed to two key things: the wealth management business, and can they continue to return capital to shareholders, given that they're expected to see these higher capital requirements after the takeover of Credit Suisse. And both of those fronts, it seems that UBS is more than meeting those expectations, reiterating they will return cash to shareholders, $1 billion this year, $1 billion next year, and $27 billion in net new assets in the second quarter in terms of the wealth management part of the business.
The numbers are outstanding. It feels like there's a little bit of softness maybe creeping into the second half of the year. We'll see exactly what is happening there. But we really need to hear from the man himself. Sergio Ermotti, he is the person that has delivered all of this. Francine spoke to him. What was he most proud of in these numbers?
Well, first of all, I'm proud that we made very good progress in the integration, and so we significantly now reduced the risk of the integration itself. And we did that while staying close to clients, deliver very good financial results, which makes me comfortable that we are on a good way to deliver on our 2026 financial targets. Of course, it's going to take a lot of time to restore the profitability, because the amount of tasks to be done is huge, but I'm confident that we are on a good way to deliver.
There's always this overhang about the capital requirements that regulators are talking about. You've been very vocal about it. How do you see it playing out?
Well, look, we started technical discussions with all interested parties. We will see how it comes out. I think that we are all for making the system more resilient, more safe. On the other end, we have to recognize that the current system has served us well, so much that we were able to step in and rescue Credit Suisse. So we need to look at the lessons learned from this crisis, but also on the other end, we need to ensure that the outcome is proportionate and is also one that allows us to continue to be a driver of growth and well-being for the Swiss economy.
So your biggest concern, I mean, at any point, could it touch dividend or shareholder buybacks?
I don't think this will happen. I think that in any case, it's premature to speculate on the outcome.
I know that there's a number of ways, of course, of dealing with this if something big were to happen in this space. One of them is probably SRT deals. Are regulators, have they given you a green light on them?
No, well, look, I don't think this is SRT are something that can be used in a focused and selective way to manage economic risk and not to manage regulatory capital issues per se. So in that sense, I don't think it's a solution.
Is there a solution that you're looking at to kind of minimize the impact on UBS?
I think it's premature to speculate because we don't know really the outcome of the discussions. We will find out probably late this year, early part of 2025, the direction of travel, and then we can make an assessment.
Sergio, talk to me a little bit about wealth management. So there's been a number of, high-profile people. Iqbal, for example, is moving to Asia. What's your biggest hope for wealth, and in what region?
Well, Iqbal has moved to Asia with his family, so I think we continue to see Asia, China, and the US as a big driver of growth. They are very important elements of our strategy, together with our position in Switzerland as a leading universal bank, and you saw also in the second quarter results, but overall that Asia continues to be a pretty good secular driver of growth for our business.
What about the US?
The US, we are. I'm glad we are making good progress with some initiatives to make the IB and wealth management working closer together. This has helped our transaction activities in wealth management. We are also preparing the platform to institutionalize more of our client relationships. So, and now with the new leadership team, with Rob Karofsky, we are really preparing for the next phase of our plans, and I'm confident that we will improve our results in the US in the foreseeable future.
Quite quickly, how aggressive do you want to be in the US in terms of
I think we have a plan, and we set our plan that we believe we need to get to mid-teens pre-tax profit margins in the next two or 3 years, and then from there onwards we will look at ways to improve further. But it takes time to do that. Of course, the environment is not really favorable. We need to do things with sustainability in mind, and not just to aim to do quick wins.
I mean, are you looking at potential acquisitions, or will most of everything will be through organic?
No, we have to do our own work and fix the issues we need to fix, and leverage better the capabilities we have right now, and they are enough driver of growth and for us in the foreseeable future.
Do you see any M&A on the cards? I mean, are you ready to acquire even something small?
We are quite busy with M&A right now, so it's difficult for us to think about M&A. So I think that we have enough on our plate.
Quite a lot of M&A done recently by Sergio Ermotti, the UBS CEO there, speaking to Francine in Zurich. We'll be over to Francine very shortly to get her assessment of what these numbers look like. I'm interested to see what the opening trade looks like on UBS this morning. Talking of trading, let's turn our attention to what's happening with the pound, Tom. Under pressure, that CPI number we've seen this morning looks a little soft.
Softer than expected. So I'll start with the headline in terms of month-on-month CPI coming in, a contraction of 0.2%. That's month-on-month. That is a bigger contraction than the surveys of 0.1% and below what we got the previous month. In terms of core, really interesting in terms of the softness that's coming through here. Relative, of course, 3.3% is the increase in core in terms of year-on-year CPI, and that again is below the survey of 3.4% and below the previous month of 3.5%. Services also cooling in terms of that part of the CPI print here in the UK, 5.2%. The estimates have been for 5.5%. The pound down 0.3%. If you've been looking for expectations around dovish central banks, you've had the action from the New Zealand central bank, you had the softer producer prices in the US, and now softer CPI out of the UK.
Does it pull forward potentially the second rate cut from the Bank of England? People are talking about November. Could it come earlier than that? It'll be interesting to see how the market ultimately kind of factors this one in. We do have US CPI coming out a little bit later on. Obviously, extended coverage of that data when it drops here on Bloomberg. We're going to kind of flip-flop between the macro data and what is happening with the corporate story this morning. Let's turn back to the corporate story now and talk about what is happening in the brewing sector. Carlsberg has increased its profit growth outlook for the year. Cost controls helping the Danish brewer to offset weaker consumer demand. The first half of the year Looks like it's been fairly soggy from the weather point of view. That's had an impact. Second half of the year, Q3 looks like we're getting off on the front foot. But remember, this is a business that is also on the M&A, been interesting on the M&A front with the BrickFit acquisition. That looks like it could determine kind of how analysts and the investment community treat this company going forwards. Let's talk now to the Carlsberg CEO, Jacob Andersen. He joins us. Nice to see you this morning. Thanks for taking the time. Look, it looks as if cost controls have really worked for you and that continuing effort is delivering for the business. But let's talk a little bit about the consumer. How weak was the consumer in the first half of the year? What's the outlook for the second half of the year?
Good morning, and thanks for having us on here again. Listen, I think you're pointing to exactly the right debate. It's been an interesting first half where we've actually seen a gradually stabilizing European consumer, then being hit incredibly hard towards the end of the quarter with a weather that was significantly below last year and normal summer seasons. So we, just like every other consumer goods company, have been hit very hard on the weather front towards the end of the quarter. At the same time, I have to say the underlying European consumer has stabilized, and we are cautiously optimistic around the European consumer. But we're not out of the doldrums, but it's not like we're deteriorating further from here. The other element of this, Hugh, is Asia, where we have to say that especially China remains, consumer confidence remains low, and we're seeing that again in the reported numbers, but also going forward. China remains a story of a very subdued consumer, and therefore the game for people like us, it's all about taking market share and drive that internal growth.
So what does that mean in terms of pricing power? How much pricing power do you have in Europe? What is your ability to pass on costs in Europe? What is the story in Asia? How different is it potentially from what we're seeing in Europe?
So if you look at Europe, I think if you look across the industry, we've all been quite capable over the last couple of years of passing on the cost increases we've seen in our core base. No doubt that it's hurt our gross margins, and when you look at this year, we're starting to rebuild our gross margins again. There's been a lot of focus on that from us. We came out earlier this year. I was speaking to you guys about that earlier this year. We came out with a big ambition on rebuilding our gross margin, and you're seeing part of that coming through in the first half, but there's a lot more work to go. Pricing as such, as a component, Europe remains very competitive, but there is a discipline amongst all of us in terms of making sure that, of course, costs that are pushed through the channels, we need to make sure that we're pricing that through. Asia is a different game. We haven't seen the same inflation in Asia, and therefore you have to say Asia is less of a pricing game. Asia is very much around the underlying growth, and it's around mix. We're seeing a continued premiumization in Asia, and that's a major focus for us. So making sure that people drink better and more expensive beers instead of focusing purely on driving growth.
Just going back to the Chinese consumer, good morning, Jacob. Thanks for joining us. You talk about a very subdued consumer in China. Do you have any clarity, any take on when you see that changing, when you see that adjusting? And what are you doing in terms of the business then on the ground in mainland China to pivot around that?
Yeah, so I'm very focused on the fact that we're running a brewery and not a bank that has to do macro predictions. When I look at what's happening on the ground, we are not seeing an improvement in the Chinese consumer. It's been relatively stable for quite a while, but it's stable at a low level. And that means the work that we're doing on the ground across China with our business, we continue to perform and we continue to outperform the market. If you look at the first half, we saw a Chinese market that was down around 5% in brewing, but we had a 3% volume growth. So we continue to take share in the Chinese market, and that's driven by strong execution around our core brands, high growth in our key brands in China like Tuborg and Carlsberg, and it's much more around that. I don't see the Chinese consumer turning just around the corner. Of course, we can hope for that to happen in the foreseeable future in terms of potential stimulus, etc., but there is nothing on the cards right now that tells us that the Chinese consumer is about to turn. So our focus is on delivering in the current environment and not hoping for a Hail Mary from the consumer improving.
OK, let's focus a bit on the UK then. You made this deal, you've agreed this deal, £3.3 billion for BrickFit. What is the latest on that deal? What stood out to you? What is attractive about that business?
Well, I was happy to see that you were just showing that the pound was dropping a bit, so that makes it a little bit cheaper. No, if you look at the transaction, The next big step here is the shareholder vote at the end of this month, and that's of course a key focus area. And then we will go through if that is a successful vote, we'll go through the regulatory processes in terms of closing the deal. We've said in today's statement that we expect that to be in Q1 next year. So our focus is on that. Of course, there's a lot of work going on internally in terms of preparing for that. But I'm also very cautious that given that we are in a UK public takeover situation, it's quite limited what I can say about the process. We're super excited about the prospect of combining with Britvic. It's a combination that will drive a lot of value for Carlsberg and its shareholders. And I think we can reap a lot of benefits both on the cost side but also on the top line side in terms of driving what we have proven across Europe, which is a strong combination of soft drinks and beer businesses.
Jacob, do you think it's fair to say that you are now going to be judged, just in terms of the way that the investment community is now going to judge you? Is it more now about Britvic than beer? Is it about the integration? Is this really going to dominate, do you think, this business over the next couple of years?
I think, of course, it's going to be a major theme. There's no doubt about that. It's a big acquisition. It's the second largest we've done in the history of Carlsberg. It adds around 20% to our business. If you look at it overall, this means that soft drinks will be around a third of the Carlsberg business, but it still means that the other 2/3 of the business is beer and beer related. Carlsberg is a brewer at the core. We will continue to drive value creation predominantly through our core beer business, but soft drinks is going to be a key strategic element towards our value creation. So we're not suddenly a soft drinks business. We are a multi-beverage business, but brewing at the core and brewing at the heart. So, but of course, any business that makes a major acquisition, it's going to be a big focus in the coming years.
Do you think, you talk about that mix, the fact that you are still going to remain largely a brewer. Just looking a long way forward, do you think the trend, though, is away from beer to soft drinks? Do you think there is a kind of a middle ground within that? How does this help with you in terms of the innovation story? Just talk about what Britvic brings to the business, not just in terms of the soft drinks it adds in terms of your mix and what you can push down the channel, but in terms of the kind of the direction of travel as to how you are thinking about product evolution.
Yeah, I think that's a fantastic point. So it truly gives us a stronger innovation capability. It gives us a much broader organization within the entire category that is non-alcoholic. When we look at how we approach our business, it's around creating strategic optionality and making sure that we have true resilience in our portfolio across categories. This gives us strength across all types of categories, and it gives us the ability to pivot and move quite fast when we see emerging consumer trends. So it gives me a better innovation muscle, and it gives us more resilience towards the trends that we're seeing. We think core beer will continue to be an important element of our business going forward, but there's no doubt that soft drinks are growing fast and will continue to grow fast. It's the same thing about beyond beer, some more hybrid products, alcoholic products. That's also a strong growth area for us. And alcohol-free beer is a big topic. If you look at the results we've just delivered, we see high growth in alcohol-free beer. We've launched more than 60 alcohol-free beers across the world over the last 3 years. So it's a massive theme for us as well. So what we're doing here is we're creating portfolio resilience and an ability to make sure that we will play and be strong no matter how consumer trends develop.
Jacob, great to catch up. Always a pleasure. Thanks for the time. Carlsberg CEO Jacob Andersen joining us on the numbers that we've just been seeing come across our screens. UBS looks like it is going to open positively. That's kind of the latest call that we're getting. We'll see just how positive it is. We'll continue to update you on what is happening there. But it looks at this point as if we're going to be plus 4% on the big beat that we've seen out this morning. We've also got Honhai data breaking as well. What is that company saying,
It's a beat for Honhai. Second quarter net income coming in at 35 billion Taiwanese dollars. The estimates have been for 34.5 billion. This, of course, is the maker of all things iPhones, iPads, and, of course, the maker, increasingly importantly, of server equipment around the AI revolution that arguably we are seeing. Earnings per share coming in a little softer than the estimates in the second quarter. Revenue a beat, though, in the second quarter, 1.55 trillion Taiwanese dollars. And again, this is a touch on the demand around some of these AI servers and that kit. The stock, by the way, year to date, up around 81%. Bloomberg had intelligence had seen a jump. They were expecting a jump in terms of 19% in terms of sales. We'll break down a bit more of the detail, of course, as and when we get it. But top line is, it is coming through with a beat in the second quarter. Operating profit, there we go, operating profit in the first half of 81 billion Taiwanese dollars, Guy.
It's interesting. It's well off its highs, though, isn't it? So it's fascinating to see kind of where we are in this journey. Sees Q3 revenue growing year on year. Be interesting to see what the read across is into companies like Apple a little bit later on. Nvidia, we'll continue to watch what happens there. But certainly the supply chain story around those companies is really interesting. We'll also talk about the Norges Bank as well. It's holding on to its Apple stock despite the fact that Berkshire Hathaway is not. We're going to take you back to the corporate conversation in just a minute. We've got plenty more CEOs still to talk to this morning. Great insight into what is happening with the European economy this morning. We've got the CEO of the utility company E.on. Huge investment story there. That is what's really driving that business. Hapag-Lloyd's CEO is also going to be joining us a little bit later on to talk about what the shipping story looks like. Plus, we're going to get a take on these equity markets. Goldman Sachs' Sharon Bell will be joining us at the Open. We're going to bring you more of our conversation as we work our way through the morning. Francine Lacroix has been speaking to UBS CEO Sergio Ermotti. Really strong earnings this morning. Looks like the market's going to react really positively to those numbers we've got from Sergio and the rest of the team over at UBS. We're also going to keep an eye on these markets, as I mentioned. Sharon Bell's going to be joining us shortly. We've got data out of the US a little bit later on. Soft data out of the UK already this morning. Keep an eye on UK stocks as a result of that. The RBNZ, the Kiwi Central Bank, cutting this morning, surprise cut, and it's actually discussed a 50 basis point cut as well. All of that needs to be folded in this morning. It's actually a surprisingly busy morning. You want to join in the conversation? IB Plus, BB TV Go is the function. Join us around the table. This is Bloomberg. There's a few things to talk about this morning. Wednesday the 14th, so you've got the Kiwi Central Bank cutting rates 25 bips, talked about a 50 bip cut. That's a bit of a surprise. You've got, obviously, soft CPI here in the UK. You've got CPI coming up in the United States a little bit later on. You've got a BOJ story that we need to factor in as well. Let's start with our Markets Live Executive Editor, Mark Cudmore, with the Kiwis. Mark, is there a read across to the rest of the world from this? Very few people were expecting a cut today, 25 basis points. Very few people, even fewer, were talking about a 50 basis point cut, which apparently was on the table. Is there a read across? Is there anything I can usefully take and extrapolate out of New Zealand into the rest of the world?
Good morning, Guy. Yes, there is the short answer. There's always a read across from the RBNZ. They tend to be leaders in monetary policy, both in terms of how they conduct monetary policy and in terms of their cycles. They can quite often be a leader as well. The one issue here, so I never want to disregard it, the one issue here is, are we over-interpreting the dovish comments? The fact that they discussed 50 basis points, the fact that they're considering that today, that really surprised a market that wasn't convinced they would definitely even cut today 25 basis points. I'm a little bit worried we're over-interpreting that. I think that was more a message that anything is on the table. They want to be flexible, which is increasingly what central banks are moving back to. They're moving back to the old world of 20 years ago, where there was less forward guidance, more that central banks just reacted to the data, and that's how we all worked. We went through an aggressive period of forward guidance amidst all the other strange policy decisions we made over the last 15 years, and I think central banks are just trying to move back from that. So I think we're in a temporary period with the PPI last night that was soft, with UK CPI this morning, with the RBNZ that was dovish. Everything is coming up dovish at the moment at a time when yields had already slumped to low levels. And I think that, you know, we're kind of pushing on a string of that narrative of soft yields, dovishness out there. I'm slightly worried that that teases up for a very asymmetric shock if CPI is strong today.
OK, before we get to the CPI of the US then, Mark, your take on that. And you nodded to the inflation print out of the UK, softer CPI. Does the data out of the UK this morning slay the hawks on the MPC?
I don't think so. I mean, look, it's certainly encouraging. What I think it does do is it backs up the idea that the UK is in a positive story at the moment, or at least it's going from a negative story to a much less negative story. And that's been a theme for the last few months, and it's going to continue. You know, UK inflation and policy seems to be having less issues, less kind of whiplash that we're seeing in some of the other countries around the world. I think, look, inflation being soft is clearly good news today. It's not a low inflation print, though. We've got to remember that. These are still high inflation numbers. So, no, the hawks aren't completely slayed, but I think it definitely is clearly a dovish set of readings overall.
So what do you think the setup is into US CPI today?
I think, first of all, I think there'll be an asymmetric reaction in yields if it's a high print. The other thing to say is that last month we saw equities really dump after a soft CPI print, which might get people confused today, but do not be confused. Our colleague Simon Flint has just put out an excellent quantitative analysis showing that was the real anomaly. And if we get a soft CPI print today, that will be lower yields, and it will be very certainly good for stocks. And interestingly enough, he actually says the outsized performer in that lower yields and move or a softer CPI print will actually be small cap stocks, not tech stocks. So that's where you get your bang for your buck today.
Okay. Bloomberg Markets Live Executive Mark Cudmore staying with us on that note that maybe it's the small caps that outperform tech if inflation moves a little lower.
I haven't seen evidence of that recently. It's interesting that the small I don't know. It depends if the US economy is slowing and they're cutting rates. There's been this argument that small caps outperform because rates are coming lower. But if the economy is slowing and rate cuts are required, then that's not necessarily particularly good for small caps. OK, we stopped the clock. Mark, I just want to stay with us for just a second. The idea, this kind of bonds equity debate, the dovish central bank story, does it lend a little bit more credibility to the idea that maybe bonds are right and equities are wrong?
No, actually it doesn't. Because, look, the inflation coming down means it supports the soft landing scenario, which is the bullish scenario that's in stocks. Remember, soft inflation doesn't mean the economy is collapsing. I still think that bonds are overly negative on the economy. And even though we're getting softer inflation print, they're not going to get away with that many cuts unless we go into recession. So, no, I think that even though these softer inflation prints don't see the jerk up in yields, it actually more goes to what equities are pricing, not bonds.
Thanks, Mark. Always appreciate it. Mark Cudmore, our executive editor for Markets Live. MLIV Go is the function on your Bloomberg. We're going to be speaking to the CEO of E.on next. Looking forward to this. Big investments. This is Bloomberg.
The amount of infrastructure that's required to run the data centers for AI is immense. And the industry is under a real challenge. It's putting tremendous challenge upon the utility industry and the electric industry in general. But the tech platform companies that are involved in AI are really struggling with this.
OK, that was the Arnold Ventures co-founder and co-chair John Arnold on the infrastructure challenges from the AI boom. You can watch more of David Rubenstein's interview on Bloomberg Wealth tonight, 6 p.m. London time here on Bloomberg TV. And Guy, we stay on the energy infrastructure piece right now with a view from one CEO.
Well, let's talk a little bit about what is happening with E.on. So it's a company that's starting to invest really heavily. So German company E.on out with numbers this morning. The first half EBIT line coming through, I think it's at 3.35. That's the adjusted EBIT line, pretty much in line with expectations. So that's the kind of the big picture story in terms of the earnings. But the real story underlying all of this is news that this is a company that has increased investment in the first half of the year by 20%. Joining us now to discuss this is Leonard Birnbaum. He is the CEO of E.on. Good morning, E.on. Good morning, sir. 20% increase in investment. That looks like it's the big story. You guys are having to spend heavily to catch up, to keep up with the demand for electricity that Europe, Germany is demanding at the moment. 20%, is that enough?
Well, first, I would say we have really two big stories which we're telling today. Number one is that we are delivering financially versus our budgets and expectations, and that is important because all the investments require that we are able to attract capital, and we can attract capital if we can show that we are reliably in delivering. So the financial results might seem to you like a sideline, but I think they are a prerequisite for us to invest. Second, the 20% increase indeed is very satisfying if you look at it only year over year. But I remind you that when I started 3 years ago as a CEO, we actually were standing at slightly north of 20 billion of investments in our investment budget. And today we have doubled that in 3 years to 42 billion. So in reality, we have increased our plans over 3 years by 100%. And what you're seeing now is only the increment year over year. And obviously, we can't double investments in 1 year because you need the people, you need the supply chain, etc. So you can do that over an extended period of time. So we are actually much more than plus 20%.
Okay. I'm in no way dismissing the fact that you've delivered on your financial numbers. They are the solid underpinning of all of this, as you suggest. But clearly there is of course, it is results day. Clearly, though, there is a huge need for investment. Are you suggesting that the restrictions on your ability to invest, though, are not financial? It is the people, the kits, the stuff you need to make these investments?
These are also relevant kind of like boundary restrictions. Currently, we have them under control. Currently, clearly, the restriction is the amount of capital we can deploy, so that is mainly limited by the regulation. I remind the listeners that we are in a regulated business, and the amount of returns that we can achieve on infrastructure investment depends on the regulation. And regulation needs to allow us to get competitive returns to attract private capital internationally. And we don't have that to a sufficient degree in all markets yet, and that is the limiting factor. If regulation would improve, we could increase our investments even further. And to be clear, the targets which are out there would require actually a further increase of investments.
Interesting on the need to attract that private capital. Specifically, what would need to change on the regulatory front to get to that point then, Ledi? Good morning.
Yeah, good morning. So we have been clear and vocal that we need the ability to outperform our cost of capital by 150 to 200 basis points. And that is a prerequisite that we have heard from our investors, which we need. And this we can do in the current environment under the current kind of like investment levels. If we need to increase them further, we need more OPEX because we need more people to deploy that. And then actually additional incremental investment dilute our profitability. And so what we need is a higher return, especially on the existing asset base. And if you compare that, it's different, obviously, by markets. We are not only a German company, we're actually active in 11 countries, not in all in infrastructure, but it's different market by markets, but we would need indeed higher CapEx return. So that means on each billion that we invest, we need to have a higher regulated return.
What do you think happens to power prices in this environment then, as you kind of project out the quarters and the years ahead? Do power prices in Europe edge lower?
I think that is really hard to say, kind of like for every consumer. It depends really a lot which consumer group are we talking about. For example, consumers that have the ability to invest into PV and batteries might actually come out with lower energy prices, I would say. You have to take the total bill. Obviously, they would be in a position to reduce their heating cost, maybe also their mobility cost, and then could cope with some higher electricity cost. Customer groups which can't invest are in a tougher position, and I think that is one of the big debates in the political arena that we have to actually sort out. How can we make sure that more people benefit from the energy transition, also in the short term, in the transition period in which we are still investing?
One final quick question from me. It kind of comes back to the investment story, but obviously the financial underpinnings of all of this, as you've laid out, are critical. There appears to be quite a significant backlog in Europe, in various places, when it comes to connecting some of the green technology that we are beginning to deploy here in Europe to the grid. How big is that backlog currently? How quickly do you think it is going to be possible to clear it?
That is depending country by country. There are countries, markets like the UK and the Netherlands, where clearly the grid is maxed out, and any connection of large consumers takes 7 to 8 to 9 years. So if you don't have a grid connection, you are in a bad place. There are other markets where the situation is slightly better, for example, in Germany. But we have to say that more and more areas are such that the clear restriction is the grid connection. You want to erect a data center around Frankfurt, I can tell you already today, it's out of question before the next decade that you even get a grid connection. Every possible grid connection that we have is already booked, kind of like a decade in advance. The situation is similar in other regions. I would indeed say that the real bottleneck for the speed of a further energy transition right now is absolutely the infrastructure, which is obviously great news for E.on because we are providing those infrastructure, but it's actually a challenge for the energy transition.
Absolutely. And it comes back to that investment story and the financial foundations you are building. Leonard, great to catch up with you. Thank you very much indeed for bringing us your numbers and the outlook. We really appreciate it. Leonard Birnbaum, the CEO of E.on. Let's get back to some of the other breaking news we've had while we've been having that conversation over the last few minutes. We've seen pricing shifting around the BOE. Post the CPI data that we've seen this morning, the inflation numbers, traders are now fully pricing in 2 more 25 bip rate cuts coming through from the Bank of England this year. The suggestion has been that maybe we get November, but maybe actually we get November and December. And that is certainly what is now being priced around this story for the Bank of England. We've also got commodity price movement, Tom, iron ore on the move.
Well, look, we think about inflation, we think about commodities as well. It's one aspect in that. And iron ore under pressure once again. It's retraced in terms of pricing this year by about a third. And no surprise that the latest warning is coming through from China, its largest steel company. And this is Baowu, warning of an industry-wide crisis in China. And that's a supply ramps up. So you're putting pressure on iron ore in terms of per tonne, 95.25 right now, down 3.4%. And again, a warning on the lack of demand coming through from that key Chinese market as supplies remain relatively robust for iron ore.
OK, coming up, you don't want to miss our exclusive interview with the Hapag-Lloyd CEO, the shipping giant reporting numbers. We'll have that conversation next. Really interesting to see what's happening and the geopolitical mix that gets folded into this story as well. We'll have that conversation in a moment. This is Bloomberg.
Proud that we made very good progress in the integration, and so we significantly now reduced the risk of the integration itself. And we did that while staying close to clients, deliver very good financial results, which makes me comfortable that we are on a good way to deliver on our 2026 financial targets.
OK, the UBS CEO, of course, Sergio Ermotti, after the bank reported second quarter net income that smashed estimates. They saw inflows into the wealth management business of $27 billion in the quarter. They say they are targeting still $1 billion, Guy, of buybacks this year and a further round of buybacks in 2025 as well. A bit of caution, though, looking forward, arguably, from what we've heard from Sergio Ermotti. But top line is it's a very strong
I think the caution is fairly minimal at this point. This is a masterclass, you could argue, in execution. There were big fears around the ability to execute this huge transaction. We're still in the midst of that, but so far so good. Every time you see a positive piece of news, every time you see the fact that the brand is still delivering, the wealth inflows are looking good, I think everybody kind of takes a sigh of relief that this is going kind of as anticipated. The numbers look good. Looks like the stock's going to open higher this morning. Francine in Zurich talking to Sergio Ermotti. He talks about what he's proud about with these numbers, Francine. The execution looks like it's going reasonably well. He does have kind of a regulatory issue that is on his tail a little bit, though, as well. How big a factor is that in terms of his thinking, in terms of his ability to execute, to deliver as he wants?
Hi, Guy, and hi, Tom. Look, I think this is like the big elephant in the room is actually the capital requirements. He won't talk about it too much. He gave us a little bit of an update. Now, we know that in the past he's really kind of, not only lobbying, but said regulation has to be fit for purpose. We know that he's worried, or at least he's making provisions. But when you talk to him, and I really tried to press him a couple of times on whether this would impact, share buybacks or dividends, he said, no, that's not the game plan. Whether they could do some, for example, synthetic refinancing if the capital requirements were to come into place. He won't really get drawn into this because he says it's just too soon. So he keeps on saying, look, let's see where we end up in terms of this capital requirements. That could be up to 25 billion. Now, what was very, very interesting is that, first of all, he was in a great mood. So obviously things are going to plan. But also investor sentiment, he says, seems to be going in the right direction. It's interesting now that they're really focusing on wealth still in Asia, with also the move of Iqbal Khan over in Asia, and then they're pushing into the US. It was also really interesting to talk about market sentiment and the fact that we had a very volatile week last week that was frankly a little bit mental by all accounts, and that he's expecting much more volatility from now until the end of the year for a number of reasons, geopolitics, but also US election.
Who wouldn't be happy? Sunny side of the lake in Zurich, life is good. Francine, thank you very much indeed. Francine in Zurich should be back at around 8:30 UK time. We'll see what this stock does at the open. Looks like at the get-go, we are going to see maybe a positive performance coming through from UBS. Let's continue with the corporate conversation. We've got many companies to talk about this morning. Let's talk about what's happening in the shipping world. Hapag-Lloyd out with its numbers this morning. EBIT margin for the first half, 9%. Revenue line beating expectations. The EBITDA line looks a little soft, but not by much. The operating line coming through a little soft as well. Let's figure out what is happening here. We're joined by Rolf Haben. He is Rolf Haben Janssen. He is the CEO of Hapag-Lloyd. Rolf, good morning. Always a pleasure. Thanks for the time, as ever, with these numbers. Look, let's talk a little bit about what you are seeing right now. Given the geopolitics, given what we're seeing in terms of the volatility around freight rates, how much visibility do you actually really have right now?
In reality, our visibility is also limited. I think all of us were surprised by the strong demand that we have seen since 1st of May. That's actually still continuing well into the third quarter, so that's in and of itself good news, but I do believe that for many people that was unexpected. And whether that's then a combination of restocking and possibly a bit of an early peak season, I think that's the hypothesis today. And I also tend to think that looking at what unfolded over the last 10 to 12 weeks, that's probably roughly right.
Okay, so in terms of what you see at the moment, the demand story, what is happening in terms of the ability to route ships through the Suez or not around the Cape, probably more realistic. Is that a normal that we can get used to? Is that something that we can extrapolate forward with?
I mean, difficult to say. I think for now, our visibility until the end of the year, I think until the end of the year, we will very likely sail around the Cape of Good Hope. Yeah. I don't see a scenario today where that is going to be different. What's going to happen beyond that, I think is largely open. And for us, we plan with two scenarios. One is that we continue to have to go around the Cape, and the other one is that the Suez reopens.
So on that then, Rolf, and good morning. How do you see freight rates adjusting? How much is priced in at this point? How much flexibility is there around freight rates to these geopolitical risks? What is your outlook into the second half?
I mean, that's of course always the million-dollar question. I think if you look at what we see right now, we still see pretty decent demand. I expect that over the full year we'll see a growth somewhere between 4 and 5%, which is really good also by historical standards. That also means that as long as we need to go around the Cape, capacity will be tight, and then we have to see, what's going to happen beyond that. Of course, there's a scenario where the Suez opens up again. Right now, it's, however, very difficult to foresee when that is going to come. And when you then ask the question, what does that mean for freight rates? I mean, we have seen a very unexpected spike in short-term rates over the last couple of months. I would expect that to normalize over the next 1 or 2 months. What happens beyond that at the moment is very difficult to foresee, as always.
Okay, maybe some normalisation over the next 1 to 2 months. On China, we were just speaking to the CEO of Carlsberg on the consumer side, not seeing really any turnaround in terms of demand from the Chinese consumer. Pretty concerning outlook there. What are you seeing in terms of the shipping demand out of that economy?
The shipping demand out of China is still very strong. I mean, if you look at the entire boom that we have seen over the last couple of months, that has been almost completely driven by exports out of Asia. If we look at where have rates been, especially short-term rates have been going up, that's been on the Trans-Pacific, that has been on the trade to Europe, and that's been on the trade to Latin America, all out of Asia. Many other trades have actually been reasonably stable.
So demand there reasonably strong, and that's obviously those are the routes that are being affected by the Gulf of by the Suez Canal, and you having to go around the Cape. Talk me through how this kind of works. Demand is very strong, but you're probably having to run your ships quite fast. I see a top line that looks pretty good. I see some weakness is the wrong word, but the middle of the P&L looks interesting right now, and I'm really interested to see what's happening on the cost front. What is happening in there in terms of costs? Are your costs higher at the moment? If we did see the Suez open, I'm assuming costs would come down. How do those two factors kind of balance out?
I mean, in principle, we see operating costs higher because of three main factors. The first one is bunker, because we have to go around the Cape. That's a longer distance, and we also sail faster. So that's factor number one. The second one is we need more ships. In order to offer a weekly service out of Asia to Europe, for example, you normally would need 12 ships. Today, you probably need 15. So that's the second factor. And the third factor is the cost of containers, because you need more boxes to move the same amount of cargo, because the boxes are simply tied up for longer. And that also means that repositioning costs are higher. So I would say those are the three factors. In the beginning of the year, we also had additional terminal costs because we had quite a lot of additional transshipment, but that has actually stabilized and is probably normalizing again a bit.
Rolf, the big question everybody in the financial markets is trying to figure out right now is are we heading for a recession? Does it feel like a recession right now? Are we entering a recession? Is the global economy slowing down?
It's, of course, a good question, and I would also like to have the answer to that. I think the only thing we can do is look at the data that we see, which is all about, what are the bookings that we have. There we have limited, admittedly, forward visibility. Right now, we do not see any real signs of a recession. That, however, of course, does not mean that it cannot happen in the upcoming couple of quarters.
Rolf, it's always a pleasure. We always appreciate your time. Thank you so much for dropping by to see us this morning, post the numbers. Rolf Harben-Jansen, the CEO of the shipping giant Hapag-Lloyd. Let's continue our conversation around some of the stocks that we are watching this morning. There are many. Joe's got a busy morning. Joe, over to you.
Morning, guys. So starting in the beer space, we've got Carlsberg out with numbers today, and actually their profit guidance is being raised, but mainly due to their cost cutting, because a lot of their volumes are actually declining. This time it's in Europe where we're seeing the weakness in terms of the growth not matching expectations. We did actually see a drop in this stock just a couple of months ago when they warned of weakening over in Asia, but it now looks like Europe is kind of adding to some of that pressure. Sluggish demand in many of its European markets, but as we can see from the screen here, the analysts remain really positive on the stock. 19 buys, not a single sell, so most people are expecting a bit of a rebound in at those shares. Then we're moving on to gambling as well. Beer and gambling, probably not a recommendable combination, but we will move over to Flutter. The company today is actually seeing a really strong growth in the US. This is due to the launch of their FanDuel business a couple of years ago, and actually reporting clients up around 27% in the last quarter, according to the firm. They, of course, do also own Betfair and Paddy Power as well, but we can see over 2 years that stock up 37%, and given a big gain in the US listing last night, we could potentially add to that. The main listing did recently shift to the US, but they still have a London stock. Both of those expected to get a bit of a boost. Also, as a side note, they're undercutting one of their big rivals in terms of some of their costs that they charge. Finally, looking at TUI, really strong booking numbers for the company and seeing a pre-market gain of around 8% on the Tradegate exchange. Does need a bit of a boost, though. We can see that stock down around 18% over the past year. If we take it back to the pandemic, a massive decline in this stock over a 5-year period, given all the debt they took on during the COVID outbreak. But in terms of their numbers at the moment, they say 80% of their bookings for the summer period are already full. Of course, coming to the end of that period, but it looks like a strong report. That one should be higher today.
Equities reporter Joe Easton with some of the stocks to watch. We'll also, of course, be keeping a firm eye on UBS, called higher after that earnings beat. Coming up, it is, of course, the market open. Futures, as you can see, pointing higher. Stay with us. This is Bloomberg.
Wednesday the 14th, just under 2 minutes ago until the opening trade here in Europe. Let's give you the legacy, the kind of the idea coming out of the United States into the European session. So this is where Europe closed. In terms of the US session, that's about there. We continue to rally post-PPI in the US yesterday. That gives us a decent tailwind. In terms of the story we are anticipating here, the first thing this morning, we've obviously got a lot of corporate news that we need to digest. Tom will deal with the details of some of the stock stories that we need to be watching this morning. UBS absolutely front and centre. But in terms of the futures, let me just walk you through what the picture looks like. This is what we are anticipating here in Europe. As you can see, a fairly positive start. You've got the stocks futures up by around 0.5%. The FTSE's up a little bit more. Keep an eye on AstraZeneca as well today. The S&P, though, fairly flat right now. We are in the holding pattern, I would argue, maybe ahead of the CPI print that's going to come a little bit later on, Tom.
So we check in, as you say, on the focus, the centrality, maybe the gravitational pull of UBS, particularly when it comes to the banking and finance stocks. That should get a lift on the back of the very solid beat coming through from UBS in the second quarter. Net income coming in more than double of the estimates, and those flows of around $27 billion into the wealth management part of the business. Hapag-Lloyd, just been speaking to the CEO there in terms of what they are seeing around freight rates. We keep an eye on them on the back of their results. Second quarter revenue coming in just slightly above the estimates, just shy of $5 billion. And Carlsberg as well, coming out with results that beat on the back largely of cost cutting, still seeing a relatively soft picture in the Chinese market. We look at Carlsberg then in terms of the response there. UBS is called higher the last time we checked by about 4%. That should give a lift again to the finance and banking sector. Guy?
Yeah, 2 to 4% seems to be the trade this morning. We'll get that print in just a moment. But it is time in Europe for the opening trade on CPI day in the United States. Bunch of corporate news that we need to factor into our thinking. So here are the numbers. Let's talk about the data. Let's see what we're seeing in terms of the opening trade here in Europe this morning. FTSE 100 opening fairly flat this morning. So you've also got the mechanical factor that the pound is down this morning post CPI. Now that normally gives the equity market a little bit of a lift because of the translation effect off that, because of so many international companies occupying the FTSE 100. So we'll see what effect that has as well, and whether we get some relative outperformance from the FTSE 100 on that weaker pound. So we're up by around 0.5% on the FTSE 100 already. The 600's out of the gate up a similar amount, to be honest. We're up by 0.4%. The CAC actually is outperforming this morning. We're up by 0.8% there. We'll wait for the DAX to open. We'll see what the SMI is doing. Italy is up by 0.5%, as is the Spanish market. Tom, there's some significant single stocks, though, that we need to be watching out for this morning. Let's get into the deeper dive on what we're seeing within these markets.
UBS currently up 3%, 2.6%. You talked about that range. We're basically bang in the middle of that in terms of what the guidance was in terms of the futures. You're currently seeing gains for UBS, 2.8% in terms of the upside in the first few seconds on the back of that sizable beat. And again, the view, the details suggesting that UBS, Sergio Ermotti, well on track in terms of absorbing the Credit Suisse business, and the wealth management part of that corporation doing very well in terms of the flows, 27 billion, and the top line beat, significant beat, double the estimates, net income coming in the second quarter of 1.1 billion. So a boost to UBS on the back of that. We're looking at the Hapag-Lloyd, I should say, in terms of the shipper, currently down 1.2%. You talked about the FTSE 100, interesting in terms of the softness of the pound, potentially offsetting some of the downside that's coming through in terms of basic resources, because that space, iron ore taking a big hit in the session, further concerns, further warnings about the demand picture out of China, and basic resources as a sector, the loss leader right now, down 0.7%. Every other sector posting some upside there. Consumers up 0.8%. Autos also getting a lift, Guy, up 0.7% so far in the session.
So Glencore's softer this morning, but the biggest points drag on the stock 600 this morning is Rio Tinto. So as Tom makes the point, you can see it there quite clearly. You are seeing that sector under a little bit of pressure this morning. What I think is interesting as well is that Novo Nordisk is once again adding some softness, some weight to the downside. Once again, it is a little softer this morning. We're down by 0.5%. It's interesting, is this in light of what we're seeing with Lilly? There's some really big events coming up in September, I am told, in terms of the obesity space, oncology as well, but obesity absolutely front and centre. So it'll be interesting to see how people position out of August into September. But UBS currently up by 2.15%. We've also got some news coming out of Norway. Let me just bring you the details of what we're seeing there. The Norwegian Sovereign Wealth Fund returned 8.6% in the first half of the year. That's interesting. 8.6%. That's a decent performance.
It's a decent performance given what we've seen year to date. 138 billion US dollars in the first half. We've talked about some of the details around their repositioning. We're going to be speaking to the CEO. Repositioning, including, by the way, cutting stakes in the likes of Meta. They still have a sizable position in Nvidia. That company reports at the end of this month. And they've added, interestingly, to some of their positions in the oil and energy space. Again, we're going to be speaking to the Norges Bank Investment Management CEO, Nikolai Tangen. Always really fascinating, that conversation. 11:30 a.m. UK time. The Sovereign Wealth Fund of Norway returning 8.6% in the first half.
They basically have to own everything, though, outside of Norway. They can't, there's kind of restrictions on what they can do, but they basically have to own everything. But it's interesting to see what they're doing in terms of the tech space performance, given what we're seeing from the likes of Warren Buffett over at Berkshire Hathaway, who has significantly lightened up on some of the big tech names. Apple, obviously, absolutely front and centre there. It's interesting to see that they're kind of sticking with some of those trades. Yeah, they're holding, for example, around as we say, Nvidia. Difference in terms of Apple, the upgrade in terms of the cycle around iPhones expected. That's what they're flagging in the second half of this year. Warren Buffett has taken that cut. So the Sovereign Wealth Fund, I mean, particularly given the focus, of course, as well on its energy credentials, or a lot of that funding, of course, coming from, most of it coming from, of course, the energy wealth of Norway, but the fact that they're also adding positions to some of those big providers and producers of oil and gas, when we know politically as well, that's a bit of a tension and sore spot, at least in some parts of the politics of Norway. Mark, Guy, I think we're going to be just name-checking you there. Mark Hudmore on the brain from our MLive team. We're also going to be listening into Amy Wu from RBC Capital Markets. I think we've been hearing in terms of some of the market volatility. The volatility has plummeted, though, in the last 24 hours. So volatility has come down. I guess, and Amy Wu Silverman's definitely somebody you want to listen to. I think her point really is that yes, we've been in for a bumpy ride, and yes, we may have stabilised a little bit, but have we forgotten that volatility? Take a listen to what she had to say.
Frankly, some people are doubling down on a lot of those short volatility trades that we've seen. That's created a lot of suppression. But look, I kind of liken this to being on an airplane that's been incredibly turbulent. Yes, we've kind of found the same altitude, but have we forgotten the turbulence? I don't think so.
Amy Silverman joining us from RBC Capital Markets on what is happening in the options market. Yes, things have stabilised a little bit, but have we forgotten the volatility of last week? No, I don't think so. Seems to be the message coming through from her. Joining us now to carry on the conversation, Sharon Bell, Senior European Equity Strategist at Goldman Sachs. Sharon, have you forgotten the volatility? Is that an event that we can put in the rearview mirror, or do you think there's more still to come?
I think that the markets don't forget those things so quickly. We had gone through an incredibly low volatility environment with incredibly strong returns in the first half of this year. So I'm not surprised that the market is a little bit more queasy, let's say, in the summer period, where you've had some more concerning data on the sort of potential for a slowdown in the US. We don't worry about a recession, but clearly the market is perfectly priced at the moment still. So, no, I don't think it'll be completely forgotten.
In terms of what happens next, are the highs in for the year? Do you think there's more equity gains still to come? How choppy do you think it's going to be?
Yeah, look, I think that if we get returns from here, it's going to be relatively low because you've had very good returns since the beginning of this year up until that correction earlier on in the summer. And look, I think that markets have got to very elevated valuations, particularly tech stocks. You talked about some investors sort of divesting a little bit of these tech names, which have got to, not bubble levels, I would argue, but pretty elevated valuations. And the overall US market got to a PE of 22. It's come down a little bit from there, but still quite high versus the last 20 years of history. So still a bit vulnerable, we would argue.
So, Sharon, good morning. What do you do with mega cap tech then? Do you hold your position, or do you fund other moves out of that space?
Well, we've been arguing that you want to diversify. So not that you want to reduce your tech allocation to zero or anything like that. We think that AI is going to lead to great productivity gains. We think that these companies are not in a bubble valuation. We think some of them will do extremely well. But we don't want everything in tech, and you certainly don't want everything either in the US. It's a highly concentrated market, very expensive by historical standards. So we would argue to diversify, not necessarily to be super underweight tech, but just equally not have a very large overweight position in something which is vulnerable every now and again to sell-offs. Having said all that, it's an area of fantastic growth. It's an area where companies are investing heavily. It's an area which will probably give you pretty good cash flows. You've started to see some of these companies paying dividends as well. So I'm not super against tech, but I do think diversifying is worthwhile. Geographically, sectorally as well, all of those things I think you get a little bit more safety from, given that volatility we've just been talking about.
Where do you find safety in Europe, and to what extent will the return of cash to shareholders continue to be a catalyst?
Yeah, it's interesting. You should talk about safety in Europe. FTSE 100 it is a pretty safe index relative to a lot of others in Europe. It tends to have a quite low beta, as we would term it. It's on a relatively low valuation, and as you say, it's returning money to shareholders. Buybacks are big now amongst many of the companies, particularly financials, energy, commodity stocks, etc. Now, no equity is completely safe, but I think that the FTSE 100, with its relatively low beta and its low valuation, and that sort of returning of cash to shareholders, makes it less risky than many other places. It's also a nice diversifier as well. It tends to be, it doesn't have any tech or very, very little tech, so it's not super correlated with those names, which I think will be a little bit more volatile from here.
More broadly across Europe, Sharon, do you think the French political tension that we saw, the upheaval that we saw in Paris, prepared Europe a little bit better for this volatility that we've recently seen? I'm just wondering if there was a sort of a flight away from risk in Europe as a result of that meant actually the books were a little bit more balanced going into what we saw last Monday.
Possibly, but possibly that could have been the case. Although I do think that the last couple of years, people have been generally quite cautious about investing in Europe, ever since really Russia invaded Ukraine. Since that time, fund flows, if you look at mutual fund data, have been more or less negative into Europe every week. So yes, I think there was perhaps a bit more heightened anxiety around the French election, that people have been sceptical about Europe, investors have been sceptical. And that's partly because of that war on in Europe and on its doorstep, raising the risk premium for Europe, but it's also because data in Europe has been weak. And European companies are very exposed to China, which, as your report earlier mentioned, has been quite a weak region. So the weakness in China, the concerns about that risk premium, and just mixed weak data in Europe, really.
Sharon, we talk to a lot of CEOs and we continue to ask them the same question. Do you see a recession? And the answer seems to be generally no. Most CEOs, while they are talking about maybe a little bit of weakness, they're not seeing the R word kind of emerging as a risk for them. At the moment, we've got equity markets more broadly around the world kind of signalling still a soft landing. The bond market is signalling something more severe. What is your kind of read on this? Are we heading for a recession? Are equities being too optimistic? Are these CEOs maybe being too optimistic?
We did raise the chance, or our view, our economists raised their view of the chance of a recession in the next 12 months. They had originally, a few weeks ago, seen it as about a 15% chance, which will put it, roughly speaking, at any random year for a recession, because about 1 in every 6, 1 in every 7 years is a recession in the case of the US. So we had a 15% chance, which is any typical year would be about a 15% chance of recession. We raised that to 25%. So we have raised it, but it's still on the lower side. In our view, actually, the labour market is pretty robust, and that's key. We think there's been a lot of distortion in the labour market because of immigration. We think underlying levels of hiring in the US are still pretty good. In Europe, we've been kind of teetering on zero, on the brink of recession, you could say, for the last couple of years. Germany has been in recession. The UK has been, again, sort of that teetering on recession level. So I think that mixed data, that weaker data in Europe has been more typical in the last couple of years. But in the US, we haven't had a recession. We think there's a 25% chance, but it certainly wouldn't be our base case.
Sharon, Guy brought up the French politics, and to what extent, to some level, that was a bit of a stress test for these European markets, particularly around political risk. As we look ahead to the elections in the US in November, how are you thinking about incorporating that risk into your strategy? Yeah, I mean, my main focus is on Europe, but the US elections are probably the most important election for Europe. More important even than, say, the French election that we had this year, or the UK election. I think as far as Europe's concerned, what happens with the US election is key. And it's key because there's been a lot of talk about restricting global trade.
Trump has talked about imposing 10% tariffs, for example, on all goods coming into the US. Now, we don't know what the actual policies will be, whoever wins, but any restriction in global trade would be a big detriment to Europe, really. Europe is really a large open economy that relies on global trade, and especially Germany. And as discussed before, Europe has had weakish mixed data in recent quarters and really has flatlined for a period of time. So I do worry about the election and that restriction to global trade. That would be a hit to Europe, I think.
Okay, Sharon Bell, Senior European Equity Strategist at Goldman Sachs. Thank you very much.
Let's talk about the core six. What are we seeing in terms of the big mega cap stocks here in Europe this morning? What are they doing? What are they delivering in terms of the performance? Broadly, we are seeing some green today. So most of the main names are higher. Ferrari in particular, definitely in gear this morning. But it's interesting to see that ASML is a little higher, despite the fact that we understand that the Norwegian Sovereign Wealth Fund may be unloading a few stocks there. But Schneider's doing well. Nestle's on the front foot. But again, there it is. Look, some weakness in Novo. It's firmed a little bit since the get-go this morning in the opening trade. But still, that stock is soft once again. What else are we watching? Let's find out. Joe Easton, over to you.
So the biggest action guy this morning is in the gambling space. A massive jump for Flutter, up 13%, the best performer on the Stock 600 today. They are reporting really strong numbers in their US sports betting business, the FanDuel business that they've been growing for the past couple of years, and also Paddy Power and Betfair in the UK getting that boost from the Euros, of course, as well. And actually, we're seeing a bit of a read-through in Entain, the owner of Ladbrokes. We can see that stock here gaining 2%. As well. In terms of some other earnings stories, TUI, now that one was up sharply on Tradegate, up around 8%, but doesn't seem to be getting the same movement. They are reporting really strong bookings in terms of most of their summer and winter bookings getting completely full out now. And then Hapag-Lloyd, you've been discussing that one, a potential easing of those rates maybe on the horizon given the spike that we've seen recently, and that would be a potential risk for the shipping company, down 4%. At the moment. There we've got UBS at the top, up almost 2%. The wealth management business, the really big boost, massive inflows there. And the trading businesses not doing too bad in equities as well. But another one in Switzerland, one we don't look at too much, is Straumann. It's up 14%, the best performer in Switzerland, really taking the shine away from UBS. Now, this company, it does dental implants of all things, and it's got a market cap of around $20 billion. Don't know what that's saying about the health of all of our teeth, but that is a massive mover today, up 14% following earnings. Then we've got Carlsberg edging very slightly higher. A lot of the negativity priced in terms of the volume weakening that we've seen in Europe and China as well. And then E.on down the bottom here, not too much in terms of guidance from that one, but potentially a bit of a cost increase weighing on that stock today. In terms of UK, I wanted to just check in on those names most affected by that drop in the rate of UK inflation. So the home builders, Taylor Wimpey, and the real estate firms, British Land, getting a little bit of a boost. Lloyd's edging very slightly higher, and Centrica as well, the British gas maker, really sensitive to those yields, UK gilt yields edging lower following that data. So all of those stocks looking pretty green in terms of domestic UK shares today following those numbers. We've got one M&A story to bring you. Rheinmetall buying a US truck maker, truck defence company. Of course, a lot of the defence firms in focus given the developments in Russia recently, but that stock adding to the massive gains that we've seen over the past couple of years on that M&A news. Then in terms of morning calls, we're looking at coffee once again. JDE Peet's, a big jump for that one, up 5%. Jeffrey says that their margins are looking a bit more encouraging. It's Kenco Coffee over in Amsterdam, and that one is up 5% almost today. And finally, we've done beer, so we'll end on pizza. Domino's Pizza up 1.5%. Investec says this is a stock to buy given growth in franchise. All those delicious pizzas. Domino's Pizza up 1.5% in London.
OK, whetting the appetite. Joe Easton, thank you very much indeed from our equities team on some of the stocks on the move. A busy day, as you can see. Coming up, Norway's Sovereign Wealth Fund sees 8.6% returns in the first half, slightly underperforming its benchmark. The Sovereign Wealth Fund also trimming some of its holdings in the like of Novo Nordisk, Meta and ASML, whilst adding to some in the energy space. We break down that story for you. The details are next. This is Bloomberg. Welcome back to the opening trade. Happy Wednesday. We're seeing gains of around 0.4% on the European benchmark. As you can see, green on the screen. It's been a big day for earnings, but also details coming through from Norway's sovereign wealth fund, returning 8.6%. That's a total of $138 billion in the first half as stocks surge. The fund, the world's biggest, of course, has pared its stakes, interestingly, in Meta, Novo Nordisk and ASML. Let's bring in, at this point, Bloomberg's Heidi Skeshev in Oslo. Heidi, break down the numbers for us then. What do they tell us about the performance of this sovereign wealth fund, and maybe what it suggests about how they're positioned for the quarters ahead?
Well, as they point out themselves, the stocks are up, their stock investments are up 12%, while their investments in real estate has gone down and underperformed. And there is a continuous debate here in Norway about how much of the fund's investments should be in equity and how much should be in real estate. Should they be allowed to invest in non-listed companies? So this debate will continue with the results.
Talk me through what we're seeing in terms of the investment story and where they're investing, and more particularly where they're not investing or maybe reducing their investments. We've seen Berkshire Hathaway, for instance, recently significantly unloading on the tech front. Are we seeing some evidence that that's beginning maybe with the Norwegian Sovereign Wealth Fund?
Absolutely, and the fund's deputy CEO has concerned that there is too much investment in tech, especially the biggest tech companies. And we do see the fund released their holdings, and it shows that they have cut slightly, not a lot, but they have cut Meta, they have cut Novo Nordisk, and they cut ASML. At the same time, the fund's top 3 investments are still Apple. They've increased their holdings there. Same with Microsoft and Nvidia. So they are talking about this, and we see some slight adjustments, but no clear path ahead.
Yeah, it seems like they're taking an opposing line to Berkshire Hathaway when it comes to the Apple story. Heidi, thank you very much indeed with the latest in terms of the adjustments from that Norwegian sovereign wealth fund, as, of course, it posted a gain in the first half of 8.6%, but as we've been discussing, reduced some of those holdings around Meta, Novo, ASML, but adding in the energy space. We're going to be speaking, of course, to the Norges Bank Investment Management CEO, Nikolai Tangen, always entertaining and insightful. That's 11:30 a.m. UK time, and there's been quite a pronounced move in gilts coming back to the UK CPI story.
I don't want people not to listen to what we do, but he does do a very nice podcast. It's very entertaining.
It's great, isn't it? Yeah. He speaks to some industry leaders. I was listening to one from James Gorman, formerly, of course, the CEO of Morgan Stanley. That was very insightful. Mark Zuckerberg as well, around AI, so it's worth listening in. Along with all the Bloomberg.
Bloomberg has a lot of fantastic podcasts as well, but he does do a nice podcast. In terms of gilts, what are we watching this morning? Unsurprisingly, you've got a bid back in the bond market here in the UK, given the inflation data that we've seen first thing this morning. The curve is moving a little bit. Obviously, we're getting a bigger move at the front end, unsurprisingly, given the fact that the market is now pricing in 2 rate cuts from the Bank of England this year. I'm assuming that's probably November and December. That seems to be certainly the thinking at the moment. Do they come a little earlier than that? We'll wait and see. Dan Hansen's going to join us shortly to run us through what we've learned from this data and what it tells us about the outlook for the central bank. Let's talk a little bit about the mining stock story as well, because in some ways it's a UK-related story as well. Some of the miners listed here in the UK are under a little bit of pressure this morning. China seems to be the narrative, and you've got this huge warning coming through from one of its biggest steelmakers, basically kind of warning of a crisis, basically, amongst the Chinese steelmakers.
I mean, the language is quite severe, isn't it? They're not holding back in terms of Baowu and one of the senior executives there in terms of the softer demand picture. So this is the world's top steel producer, just in terms of the context, the size and scope. And this is China, Baowu Steel, and their chairman saying that they're facing a severe winter in terms of the demand picture, a crisis more difficult to endure than we expected, at a time of increased supply around iron ore coming through from the likes of Rio Tinto. So yes, you're seeing further pressure in terms of iron ore prices. $95 a tonne. It's given up about a third of the gains of the year, down 2.8% in the session, and again a further warning sign around the health of China's economy, and that links to the real estate crisis that has not yet been resolved.
And you're seeing that in copper, you're seeing it elsewhere. It's not just in the iron ore story, but it's elsewhere. It's not just in steel. It seems to be across the board, particularly. It's interesting what we did hear from Hapag-Lloyd, though, talking about a kind of boom, export boom, basically coming out of China right now. That side of the economy still appears to be very, very strong.
Yeah, multifaceted economy. The export leg of the economy has been a little volatile. We have seen some data suggesting that exports are cooling down. If you get a recession in the US, it remains not base case for most economists, of course, but if that comes through, that could prove a challenge. But as you say, interesting to see that at the touch point, at least for that shipping company, they are still seeing quite decent shipping demand out of China. Coming up, we are, of course, going to bring you back to one of the big earnings stories of the day. This is UBS, pairing some of the early gains, but of course, top-line results came in very strongly indeed, Guy, and we did see those inflows into the wealth management business. We've been hearing from Sergio Ermotti.
He seems in a very good mood, according to Francine.
Yeah.
Life is good in Zurich right now. The plan seems to be largely on track. He is delivering. He's got some regulatory issues, which I think are going to factor into his thinking, maybe in the second half of the year. But so far, so good. And I think that's really what the market wants right now. It's just, are you able to execute on the plan? Is the integration on track? Because ultimately, if it does work, there's huge upside there. So the longer it kind of stays on track and the longer they deliver, that's great news. And the brand certainly seems to be getting some traction right now. Anyway, we'll hear more from Sergio in just a moment. This is Bloomberg.
I guess for the markets and for many investors, what happened early on this month has been a wake-up call, right? So, I mean, you look at the magnitude of the movements should make people think carefully about having a proper diversification and being very thoughtful about the way you invest money. So in that sense, the fact that we have basically made back everything within 1 week or two cannot be taken as a temporary issues. In my point of view, one has to really think that probably is a sign of some elements of fragility in the system.
But does it get easier as maybe we get a Fed cut, or does it get more complicated as we go to the US election?
But look, when central bank cuts, it depends how they cut and why they cut. So if of course, there is now a capacity probably to accommodate cuts based on lower inflation. But it's also, we need to watch exactly also what are the underlying economic drivers, and to the extent that the Fed is forced to cut more aggressively because of economic downturns, that would not really be good for the market. So we need to really watch why rates would come down and how quickly they come down. In general, we do expect and we see room for a potential rate cuts in the foreseeable future, but I wouldn't really be in the camp of predicting that the Fed will go as far as the market wants the Fed to go.
Why is that?
Well, because I think that probably the market is used to see central banks stepping in every time and being very accommodative in the previous cycles. And I think right now it's quite clear that central banks are focused also on inflation, and therefore they don't have so much capacity to go as far as the market may want to see.
UBS CEO Sergio Ermotti, of course, after the bank reported those second quarter net income details and numbers that, of course, smashed estimates. The stock currently up 1.2%. Let's cross over to Francine Lacroix, standing by for us in Zurich. Of course, conducted that interview with the CEO of UBS. A really sizable beat then for the business. How big a win of this is this personally for Sergio Ermotti, who, of course, was taken on after the merger with Credit Suisse, the takeover of Credit Suisse? Francine, good morning.
Hi, good morning, Tom. I think it's a big win for him. And actually, he came into the interview, he was quite upbeat. He seemed quite confident, probably pleased with the results. If you look at what they've achieved, look, what's very crucial is that the bank is in tip-top shape for when extra capital requirements come, if they ever come. So if you look, for example, at cost savings in some of the units, it's extremely important that whatever they can do that's in their hands, it gets done today if they have to put more capital to one side. And this was something that he was not keen to talk about in terms of capital requirements, but he was keen to talk about the fact that they were very close to their clients, that they had a good quarter in terms of wealth management, that in terms of trading, everything was okay. And so he was also clear in saying, look, we've done quite a lot in savings with Credit Suisse. What we've promised, we delivered. And then the question mark is, of course, what happens in terms of capital requirements and what that means for the business model.
Francine, you bring up the issue of regulation. at the moment, the integration looks like it's on track and is delivering. Is regulation, therefore, the biggest risk around UBS right now?
It is by far, and actually it's something that Sergio Ermotti didn't really want to be drawn in on. He says, look, it's too soon to speculate. But remember, it was about 5-6 months ago that actually we heard from the Swiss government and Swiss policymakers that they were possibly looking at asking banks, UBS, to hold more capital. Now, then we had speculation in the media and also by investors and analysts and saying, well, how much could that extra capital requirement be? I mean, if we're talking $25 billion in extra, does that put the UBS plan in jeopardy? Does it put dividends and shareholder buybacks in jeopardy? Now, again, when you ask Sergio Ermotti, and I asked him not only this quarter, but the quarter before, he says it's too soon to be drawn in. He did say, in terms of timeline, they'll probably have a clearer idea, a clearer picture, by the end of the year or early 2025. What we also know behind closed doors is that he's lobbying the government. He's trying to tell them, look, they need to service clients in Switzerland and elsewhere, so they just don't want that extra regulation, because I think there's a personal belief within the bank, and certainly by the chief executive, that this is a safe bank that doesn't need any extra capital to be put to one side.
And look, Francine, clearly this is a CEO, it's an executive, a banking leader who's seen a number of upsides and downsides when it comes to these capital markets. The moves, of course, the stunning moves that we saw last Monday. What was his take on some of the volatility that we've seen, recent volatility in these markets?
Well, I mean, again, it's very clear that we kind of, all agreed that it was quite extraordinary moves. Now, whether this means that we're going to see a lot more volatility ahead, Sergio Ermotti talked about geopolitics. We mentioned U.S. politics, but of course, it all boils down to the Fed. Now, today we have that U.S. CPI number that will be very closely watched. He believes that the Fed will cut. He did say that they probably won't cut as much as the markets believe, because there's an anticipation, the markets, that central banks will always be there. And he says that won't always be the case. And when you look at, again, market volatility, he talked about the need for clients to diversify, certainly in the wealth management, which fits in, I have to say, very well with his proposition of growing the wealth management business, especially in Asia and the US, in trying to get bigger and closer to clients. So for a big bank like UBS, as long as they're not on the bad side of a trade, volatility and uncertainty, especially when we go back to that 60-40 portfolio, might be a good thing for them.
Francine, great coverage, as ever, out of Zurich on UBS. Thank you very much indeed. Francine will be back throughout the morning, keeping us updated on what is happening. She'll be back in the Pulse, of course. Her show coming up very shortly. Let's turn to some of the other corporate news we've seen out this morning. Hapag-Lloyd, the giant shipper, reporting an EBIT margin for the first half of 9%. We caught up with the company's CEO and talked about kind of what freight rates are going to look like in the second half of the year.
We have seen a very unexpected spike in short-term rates over the last couple of months. I would expect that to normalize over the next 1 or 2 months. What happens beyond that at the moment is very difficult to foresee, as always.
That was the CEO of Hapag-Lloyd, Rolf Habben-Jansen, joining us. Let's carry on the conversation. Brendan Murray, this is his world. Let's talk a little bit about what is happening within that world. Brendan, great to see you this morning. Unexpected seems to be a word that keeps cropping up when I talk to some of the CEOs of the big shipping companies. How much visibility do these guys have right now in terms of what is happening with freight rates, their ability to navigate the Suez, what is happening globally in terms of the demand story?
Well, if you listen to what he said, he maybe 3 months visibility is about all they have. Maybe to the end of the year, he said that they would go around the Cape of Good Hope, avoid the Red Sea attacks till the end of the year. So, but he also said that the demand that they saw it was very healthy in the second quarter is continuing in the third quarter. So, if you're looking for signs that the world economy is sliding into a recession, you're not seeing it in the numbers in global trade right now.
Molly Maersk and executives there earlier saying that they don't see those tensions and the disruption around the Red Sea clearing until, well, they see it continuing essentially into 2025. What is the longer-term impact for this shipping industry as they adjust even if that clears up, you've got further risks in the Middle East, you've got further risks around political tensions between China and the US, a potential Trump presidency. How do these shipping companies adjust longer term?
Well, I think the way it's going to reflect on the customers of shipping lines and consumers ultimately is those shipping rates. You heard the CEO of Hapag-Lloyd say it today. They're going to normalize, but they're not going to come back down to the levels that they were pre-pandemic, the very low levels. So they're going to come down a little bit, but it's still going to be expensive. As he said, It takes 12 ships to go from Asia to Europe right now a week. It used to, now it's 15. So it just builds in extra costs. I think that's the near-term impact.
If we were to see the Suez Canal situation opening up, say the Suez opens up and you go back to having to need maybe the 12, do you still need the 15 though, just in case it closes down again? That risk is now there. Do I have to have a bigger fleet, which means in times when, or more normal times, actually, I'm probably going to be running with excess capacity? Does this increase the volatility, the kind of the amplitude of the swings we're going to see?
Yeah, definitely. I mean, the capacity adjustments that they'll have to make fairly quickly will affect. We'll see those in spot container shipping rates. At the moment, they're still pretty elevated. They've come down a little bit. They are expected to come down a little bit more. But if they continue to go around, avoid the Suez Canal, there's a limit to how far they'll go down. The shipping lines, by the same token, have ordered a lot of new ships. They're transitioning from old fuel to new fuel ships. So a lot of those are coming online. So the bottom line is the shipping industry is going to be very volatile, very difficult to predict.
But you're going to have to run bigger fleets generally just to deal with climate change. You've seen it with when it comes to what is happening with the Panama Canal as well. Geopolitics when it comes to running with the Suez Canal as well. What is this? How big a fleet's going to have to be?
Well, it depends on what the demand is. And we're seeing good demand right now. The Port of Los Angeles yesterday said they had their busiest July ever. Wow. So if that's sustained, a lot of that is restocking. A lot of that is pre-ordering ahead of the holidays. Yeah. But if that's sustained, then the shipping lines are going to have to maintain those larger fleets.
And we touched on China with the CEO of Hapag-Lloyd, and he's actually seeing strength there in terms of shipping demand. What is the China input right now into global trade?
Yeah, exactly. I mean, China was what about the great decoupling that we were supposed to see? China is as involved in the global economy as it has been all along. There have been some disruptions at ports there, but for the most part, goods are flowing. The Port of Los Angeles executive director said yesterday they just shipped a record number of empties back to China, which tells him that those empties are going to come back across the Pacific full of goods. So we're looking at several more months of strong demand, at least in the U.S.
Are the problems on the East Coast going to affect the West Coast? We saw the West Coast having issues a while back in terms of the strikes. Is the East Coast problem now? And is that going to exacerbate some of the problems that we're seeing on the West Coast in terms of that demand story?
Right. We're 6 weeks away from the deadline for the East and Gulf Coast dock workers to get a new contract. There's a lot of talk right now that they're at an impasse. Of course, that's how these talks go. Nobody's budging until the very last minute. But that's one of the reasons why LA is seeing so much volume is the pre-ordering, the nervousness, the shifting from the East to the West Coast to avoid any potential disruptions. A short strike in the East Coast dock workers, will be absorbed fairly easily. But if it drags on for several weeks, it's the November presidential election in the U.S. as well. The stakes only get higher. So it's definitely something it's causing disruption at the moment, and it's going to get even more tense as we get closer to that September 30th deadline.
Yeah, really interesting. And you imagine there's going to be a political overlay, as you suggest, to those conversations from both parties running up to November. Bloomberg's Brendan Murray, who leads our coverage of trade and supply chains on what we're seeing globally in terms of how these supply chains are adjusting. Here's what else you need to know this morning then. Ukraine's Volodymyr Zelensky has instructed troops to prepare for more action. That's as Kyiv continues to make advances in Russia. The country's army chief says 74 villages and towns are now controlled in the Kursk region. Meanwhile, Vladimir Putin is said to have called in a trusted aide and former personal bodyguard to monitor Russia's operations to expel Ukrainian forces. And Japan is set to get a new Prime Minister. Fumio Kishida says he won't run for a second term as leader of the long-ruling Democratic Party this September.
今回の総裁選挙では自民党が
The LDP needs to show that it's changing and that the public can see the transformation. The best way to do so is for me to step aside. Therefore, I will not be running in the upcoming LDP leadership election. I will devote myself to supporting the new leader selected to the process as a foot soldier.
And in corporate news, Starbucks shares jumped. They soared, in fact, after the firm ousted its CEO and hired Chipotle's Brian Niccol as its next leader. Niccol starts his new role next month. The shakeout comes after activist investors amassed stakes in the company. The abrupt exit adds to a record number of CEO departures from US companies. Niccol, of course, has that track record in turning around companies, including, of course, Chipotle. Coming up, as UK inflation rises less than expected, what does that mean for the consumer and the BOE? We check in on the inflation data and how that is adjusting betting around the BOE's next steps. That is next. This is Bloomberg.
Wednesday the 14th, 48 minutes into the equity market session. This is how we are looking this morning. As you can see, generally bid across the screen. You've also got a bid back into the gilt market as well this morning. Stands out, really, in terms of that bid. Everywhere else, bond markets are on offer, but gilts are bid this morning. The reason for that, UK inflation increasing in July, but less than economists and the Bank of England had forecast. Services inflation posting its lowest reading in more than 2 years. Does this accelerate, bring forward, bulk up interest rate cuts coming through from the Bank of England? We've been discussing this all week as we work our way through the data that we've been getting this week, and there's been a lot of it out of the UK. Dan Hansen is back, Bloomberg Economics chief UK economist. First up, what do you make of those numbers?
So it's a weird one, isn't it? Because objectively, a rise in inflation shouldn't be good news, but when we look at it, we're looking at relative to forecasts. And as you said there, we undershot both our expectation, the Bank of England's expectations. So on a headline basis, I'd say...
It's still a high number, though, isn't it? And I think that's the point you're making, maybe, yeah.
Yeah, I mean, 2.2, it's not going to...
above target.
It's above target. It's not going to... I mean, we're not at 11% anymore, clearly. So it's not, it's not going to cause big worries at the Bank of England. I think the key point is around services inflation.
That's really, the point I'm making, yeah.
And you're right, that is still high at 5.2. That is still high. And actually, interestingly, a lot of the fall from 5.7 was a lot to do with what the Bank of England likes to call volatile categories. So there's a bit of a story there about how good news this print really is. So if you strip out things like the Taylor Swift effect that we had in June, that's reversed this time. Airfares and all the bits that are a little bit more volatile month to month, actually it looks a little bit more stubborn. So I think it keeps them on for cutting more for the rest of the year. How far they'll go, I'm not yet convinced that two more cuts is right. I think one is more likely.
You're not convinced because September hadn't really been in play for these markets up until today. And now, look, it's not base case, but it's starting to get traction, the idea that they could go in September. Prior to the data out today, it was November. And possibly 44 basis points by the end of the year.
Yes, that's right.
Now you're above that, and September's in play. So what holds them back from doing two?
I think it's that services print. I mean, if we get another CPI before the bank meets in September, so if we get a big downside surprise there, the probability would go up again, clearly. I think the other thing to remember about this is what happens over at the Fed. So the Fed meets the day before, or the decision is announced the day before, I should say, the bank meets. If Powell flags that there's a problem with the jobs market, they go 50. I think that would really raise the prospect of the bank moving in September, and it would be about putting in some precaution into the policy stance. It wouldn't be about the UK economy is falling off a cliff, we're heading for a recession. It would be about the UK economy is a small open economy. What happens in the US matters for the UK, and we're just going to put some insurance in place to be sure that we're not going to sort of fall off a cliff ourselves, if you like. So I think there need to be a few things that happen between now and then, and at the moment, I don't think we're there. At the moment, I think November is still a reasonable base case for the next move.
OK, but the caveats are around the Fed and around services and that part of the inflation mix with that data coming up next week. Dan Hansen, of course, Bloomberg Economics, with the focus on the UK. On the market reaction then, to a day when, of course, you've seen that surprise cut coming through from the Central Bank of New Zealand. You had the softer producer prices, of course, out of the US as well. We lead up to CPI later today. Commentary from Raphael Bostic, but nonetheless, softer CPI here in the UK. You put all that together, maybe push aside Raphael Bostic for the moment, and it looks like a more conducive and constructive moment in terms of the bond markets. And we saw money moving into treasuries yesterday. Rachel Evans from our strategy team, or rates team, talk us through what this moment is and what lessons we can draw from the RBNZ, the softer data out of the UK, out of the US, and whether or not this is something of a change in terms of how we're assessing the central banks.
Well, I think the RBNZ is an interesting one just because it shows you how quickly things can change. I mean, they, as recently as May, they were talking about, sort of potentially doing another hike and being, waiting to cut until 2025, I think is what they were saying. Now we've seen them come out and cut today, and they've talked about how they actually discussed having a 50 basis point cut. So it shows you just how quickly a central bank can go from talking about prospective hikes to actually cutting and thinking about big cuts. And I think that's where it's kind of relevant to how the market is really viewing this setup for US CPI. Given we had so many gyrations in the market last week, and there was a real kind of sense that, the US economy was faltering, that we were heading sort of really rather quickly towards a recession environment, and that the Fed was going to have to cut quickly, maybe even before they got to their September meeting. We've kind of got this situation where we're kind of going into CPI with people looking to that as really sort of vindication or sort of, proof that those perceptions have some merit. And I think kind of, what the RBNZ told us was that, these things can change pretty quickly. And if we do see CPI really showing some softness in the wake of kind of some of the jobs data also showing some softness, that could be enough to kind of give the green light to traders that, the Fed's going to cut in September and it could cut really big.
How much that's already priced, though? Like, bond markets are signalling already that we are in a fairly dismal picture, or we have a dismal sort of outlook picture. Where is the risk? Is the risk that actually the number undershoots today? Do we get a kind of, how asymmetric is the reaction? If we get an overshoot in terms of the number, do we get a bigger reaction on the upside versus a downside miss?
As you can imagine, this is something I've been trying to figure out this morning as we're kind of preparing for the release. Honestly, I think there's a risk either way, because we have seen a pullback from some of the gyrations we saw last week. We're about 80% priced for a 50 basis point cut in September, which is pretty out there. Like, that's, given what Powell was saying at the last meeting, that requires a very large pivot. We do have Jackson Hole coming up next week, where we may get more of a sense of whether that's something that they would contemplate. But, that's where the RBNZ does show how quickly these things can happen. I would say, given how long the Treasuries market is now, and we are seeing kind of open interest in 10-year futures at a record high. We're seeing, I think JP Morgan had a client survey out this week showing that their clients are the most long since December. Everybody is positioned for more rally, for more cuts to be priced. That seems like we might be over-egging it a little bit, given where Powell was very recently. So I think there's going to be potential, if we do see CPI come in, as people are hoping and expecting, there could be quite a big rally. That's where people are positioned. That's where the market wants to go. But if we don't see that, they're so positioned towards the longs that there's going to be some covering. So it could be quite a sharp move either way.
The BOJ clearly was central in terms of tripping up the markets last week, one of the key factors. Now we have change at the top coming through in terms of leadership, the Prime Minister stepping down and a new leader as yet unknown to take over the helm. I wonder how much policy uncertainty there is then, given the linkages between the Prime Minister in Japan and the BOJ.
Yeah, I mean, it's a really good question. I think the market is still trying to pass through exactly what this means. Like, markets hate uncertainty. Any uncertainty is always a reason to sell. But looking at the markets today, like, dollar yen is pretty stable. But what they're going to really want to look to see is that there is a path of certainty kind of coming through in coming days and weeks. Like, the Prime Minister who's outgoing was very unpopular, got really hammered by, obviously some domestic scandals around slush funds, but also inflation and that weak yen. So they're going to want to be listening for some of the rhetoric that comes out of the potential candidates to replace him. Where do they stand on the yen? Do they want a weaker yen, or do they see kind of having kind of a strong yen and the yen having weakened too far as something that they want to kind of push back on? So I think it's going to depend a lot on what the commentary is that kind of comes out from those candidates.
Fantastic as ever. Rachel, nice to see you this morning. Thank you very much indeed. Busy day coming up with the US CPI data to drop a little bit later on. Some great coverage. coming from Bloomberg. Let's talk a little bit about what is happening with the markets right now. UBS, let's quickly check in. It's faded the early move, certainly from first thing, but we are still up over 2% on that stock story. Novo, I've been questioning why the stock has been down over the last few days. Somebody suggesting on IB to me this morning, maybe you could draw a line between the Norwegian Sovereign Wealth Fund selling and maybe some of that weakness coming through. But as you can see, the stock's not done that badly. Francine is up next. The UBS story front and centre. She's in Zurich. This is Bloomberg.